Hey guys, Stock Saturday, and it's been a fairly rough week, certainly for me at least. Down about 14.5%, sort of good 65,000 or so. This is largely on the options side, sort of due to crypto. It's taken a reasonable pullback, and gold and silver sort of taking a bit of a hit during the week as well. And Hymax as well, sort of is all over the place at the moment, or the stock sort of a little bit up and down. That means the options are sort of absolutely all over the place. Compared to the Nasdaq, 2.75% down for the week, and the S&P is 2.19% down for the week. Both sort of took a little bit of a drop on the FOMC announcement during the week, which I'll come to. But yeah, sort of reasonable amount of other moves. Broadcom sort of having a really good week off the back of earnings, and then sort of dropping back. I think got to 253 sort of the highs. I was quite tempted to take a little bit off the table, but yeah, didn't bother in the end. Couple of acquisitions, Ingredient and Euronext, which I will come to in a sec. But yeah, let's take a look at sort of what caused this big drop for the week. So we had the summary of economic projections at the FOMC meeting. We knew they were going to cut 0.25%. That was kind of baked in, but it was really all about this and sort of how they see things going forward. So this sort of largely seems to have been a bit hawkish, less rate cuts than expected because of better economic conditions. So you've had real GDP after inflation rising to 2.5% for this year. They were expecting 2 in September, so they're thinking a good push in the final quarter. And next year they revised up slightly to 2.1%. They did actually knock 2027 down slightly. Not really sure how you see quite that far in advance. These all get massively adjusted between now and then, but yeah, for some reason they dropped that down. Unemployment, they're saying, is going to be better than expected. They dropped this year down to 4.2%. Next year down to 4.3 from 4.4. Again, raised 2027. They're sort of expecting something bad in 2027, I guess. Raised the PCE and core PCE inflation numbers, so they're expecting with this better growth, a little bit more inflation, not coming back down to 2% quite as quickly as they'd hoped. They're still putting it as longer run, or they're getting there by 2027, where they had said 2026. And yeah, they're still, well, they say if they're cutting, with it still at, 2.8, that's what they always go by, core PCE. They're cutting with it there, so they're not all that committed to getting it to 2%. They have sort of said in the past it's an average, and they're happy for it to run a little higher than that if long term its average is 2%. So whatever. But yeah, this all led to Fed funds rate, basically 4.5%. They were expecting 3.5% next year, and yeah, they're now saying 4% basically. So 2 cuts next year instead of 4, and everyone was very, very unhappy about that. And 2026, they were saying another 2 cuts, and they are still saying 2 cuts, but they're only sort of saying 3.5% by 2026, where they were saying 3%, and sort of 3% being the longer term goal, basically, which it still is, although it's up from 2.9 to 3%. So they are sort of edging that interest rate, sort of neutral rate, where it's, not sort of restrictive and not easing. Edging that up, it was 2.5, I think, at one point, and it's now 3. So we're not going back to 0% rates anytime soon. And just coming to the dot plot. So everyone likes the dot plot. I quite like it as well. This is sort of tightening up. Certainly these longer run ones, 26 and 27, were, a great big straight line of no one really having any idea. Going from 1.5 to 4.5%, I think, on some of these longer term ones. These are now tightening up. People sort of seeing, basically 4.5% end of the year. That's where we are, and sort of 4% basically for next year, and then sort of in a relatively tight range between sort of 3 and 4% for 2026. So yeah, everyone got very, very unhappy about this, but I think when you sort of settle down and get used to it after a little while, the fact that it is because of forecasting better economic conditions, lower unemployment, higher GDP, if it is at the expense of a little bit of inflation, that's sort of fair enough, and they seem to be happy to accept that. I think sort of wanting worse economic conditions, more unemployment, just so you get a couple of interest rate cuts is sort of counterintuitive, I would say, for large businesses sort of reliant on a lot of revenue. Sort of missed TSMC's monthly revenue number a couple of weeks ago. They released their November figure, which was pretty good, 276 billion new Taiwan dollars, slightly down from October, but that is sort of seasonality. This November number was 34% up on last year, where the previous month was only 29% up on last year. So pretty consistent all the way through the year, sort of 30 to 40%. Beginning of the year was 215 and the sort of high 100s, now 276. So very nice. Not really sure where this is coming from, whether it be Apple iPhone sales, Nvidia sort of continued popularity and explosive growth. We did just have Intel's newest graphics card release, which is using TSMC, and their reviews are looking pretty good. So maybe they will want to sort of continue subcontracting things out to TSMC. A lot of people see that as a sort of admission of failure, but yeah, I wouldn't really see it as that. It's graphics cards are less of a, I suppose, somewhat less of a focus for them. So yeah, them doing the end product and just having the chips themselves made by TSMC, I would say, is fine. So we had Broadcom's results. Everyone was sort of very, very excited about these. It doesn't seem to be an absolutely blowout earnings themselves, but it was sort of the guidance that everyone got worked up about. Revenue up to 14.05 billion from 9.3. Obviously, this is still acquisition numbers, comparing to pre-acquisition. Net income sort of 4.3 billion compared to 3.5. That's unadjusted. They're I call it digesting the acquisition, amortization of various costs, write-downs of some things and goodwill and all sorts. So yeah, that needs to work itself through. They give you a sort of adjusted number of 6.96 billion compared to 4.8 net income. Pretty solid. And then sort of per share, including the dilution for the acquisition, they're saying 90 cents compared to 83 cents, but making those same adjustments, it's $1.42 compared to $1.11. So that is pretty good. It's an accretive acquisition. It was worth doing. Basically, these numbers obviously don't include the debt that they've taken on as well. That's only the stock dilution, but that debt will go over time. And then yeah, we're now looking at sort of $1.42 rather than $1.11. So pretty nice. They are now 41% infrastructure software, 59% semiconductors, where it was 21 and 79. So a little bit more diversified, sort of getting towards, if you look at the full year numbers, 42 and 58. So, almost becoming a 50-50 semiconductor and software company, which is quite nice. And yeah, the guidance I think is what everyone got very, very excited about. We had 14.6 billion guided for the first quarter of the next fiscal year, and 66% adjusted EBITDA guidance. So when they made the acquisition, they were sort of setting a target basically of 50 billion of revenue for the year, which, this would be sort of 50, 57, 58 billion. I think the target was for this year, but yeah, certainly sort of within a year getting to like 58, 50, yeah, 57, 58 billion of revenue. Pretty solid. And adjusted EBITDA margin, you would sort of think would stay roughly the same. They were projecting 60%. And they're now saying 66% for this quarter. So if that's somewhat durable, then that is incredible for margins. So very, very nice. I think that's what people probably got fairly excited about. You had a dividend, 59 cents, which is, I believe, a raise. Don't really sort of focus all that much on the dividend, but yeah, people like it. I always say, focus on the profit, and the dividend sorts itself out. And balance sheet still looks absolutely all over the place. You got cash down a little bit. They used some of this cash. Goodwill up to 97 billion. Intangible assets up. Really need to sort of see comparison once the acquisition rolls over into previous year, and we can sort of see when they start paying some of this debt down. 66 billion in long-term debt. Not ideal, but yeah, it's worth it. It seems the acquisition was accretive, certainly worth it, and yeah, we'll see how they do going forward. But everyone seems reasonably happy. It shot up to 253 and sort of only pulled back really on the FOMC announcements. So the first of my new acquisitions this week was Ingredient. Sort of keen on expanding this sort of food and agriculture little segment that I've got, and not wanting to sort of go the traditional, food-based companies everyone sees, or food and drinks-based companies. Everyone tends to go for things like Coke and Pepsi and McDonald's and things, and I sort of see them as a little bit less healthy, a little bit discretionary. People sort of say when times are hard, people go to McDonald's, and I sort of think when times are really hard, people aren't probably going to McDonald's because it's not that cheap. It's cheap for a takeaway, but I sort of think people aren't going to be having takeaways if things are really hard. And sort of growing population, a lot of the sort of emerging markets and the less developed world aren't having McDonald's anyway. They want staple foods, and yeah, so I prefer to go for more basic, base ingredients. I always liked Archer Daniels Midland. Sort of haven't added that. They seem to be in a hell of a lot of trouble at the moment, so they're on the watch list. But yeah, Ingredient was the latest of these additions, and they sort of seem to, I would call it, do the ingredients on the back of a packaged food product that you sort of don't really know what they do and sort of can't even pronounce some of them. So you're looking at, as they have in our ingredients bit, allulose, sort of sugar alternatives, emulsifiers, extracts of things, fibers, gums, dextrins, all sorts of stuff that you sort of think, don't really know what that is, and you kind of look past them. Plant-based proteins, artificial starch, and that sort of thing. It's sort of probably a fairly evil company overall, but yeah, I think as far as packaged food goes, we just seem to be seeing all this stuff more and more. If you eat, fresh fruit and veg and fresh meats, then you're not going to see sort of very much of this too much. But yeah, certainly the packaged food side of things, we are more and more, and their sort of slogan, seems to be this focusing on the and. So people wanting amazing taste and better nutrition, and they have, additives to make what are normally unhealthy things maybe a little bit healthier and enhance sustainability. So you're sort of artificial preservatives and making things, taste a little bit better while not being quite so unhealthy. But it is basically doing that somewhat artificially. They call it, preferring sweet taste without artificial sweetener, but it's not just sugar. It is sort of kind of artificial things. They're focusing on specialty sweeteners, sugar reduction, various nutrition things, modifying um, flavors, texturizers, making sure they do a lot of free from stuff by the looks of it, gluten free and sort of dairy free, and those don't retain the texture always of the original thing. If you've had vegan cheese or sort of gluten free bread and that sort of thing, it doesn't really taste like the real thing all that often, and they have sort of various products and additives to try and bring that back to the original, basically. And then sort of your plant-based proteins, sort of vegans and vegetarians and things wanting to eat less meat, you need to get protein from somewhere. So yeah, all these sort of pea proteins and isolates and all sorts, basically. As I say, I think they sort of seem to be going more and more towards this sort of thing, certainly in the packaged foods space. So yeah, see this as basically an essential. And financials look pretty good. I'll come to that maybe on the next quarterly earnings. So we'll see. The next one was Euronext. Sort of playing footsie boys, Steve, in the Discord. If you're in the Discord, kind of put me onto this, or made me sort of have another look at least. Never really considered European sort of exchanges all that much, but yeah, they look pretty strong, and it seems to be somewhat of a monopoly. Not the biggest market cap company. I think it's sort of 11 billion euros, sort of for basically the biggest group of exchanges in Europe, and from what I understand, the largest issuer of debt in the world. They sort of do fixed income trading, but they issue trillions on behalf of people wanting to sort of market that debt. And I'm not wanting to hold debt myself because of sort of massive money printing. Having somebody that is a part of issuing that debt and takes the fees on it at a reasonable profit margin is a very nice compromise. So, yeah, quite like that. They show you their little pie here, sort of quite a diversified company. They do sort of cash trading, listing of new companies, fixed income trading. They sort of have a little bit in derivatives, FX trading, that sort of thing. Clearing, so they'll be the man in the middle of some of these larger trades, making sure both sides are healthy and can finalise that trade. Custody, settlement, so they'll sort of hold people's assets on behalf of them, and then sort of selling data. 16% of revenue is pretty good. Sort of more subscription based, not relying on just volume and new listings and that sort of thing. Just data, however the market is doing. So yeah, not a huge company. 396 million in revenue in total, but decent margin, 30+%, sort of 35% in the good years, is really, really strong. It's, big tech, sort of Mag 7 margins. I mean, some of the Mag 7 don't even get that. Sort of when you think of Apple, I don't think sort of get anywhere near that. So, yeah, 35% and a sort of fairly monopoly, moaty type business. I really like the look of them. You sort of note I'm wanting to expand this financials little section of mine, sort of BlackRock, CME, and Euronext. Never really been keen on sort of banks. Don't like the financial fractional reserve model. Um, so yeah, not really that keen on banks. I've had insurers before, sort of Legal and General and Aviva, and sort of not really all that keen, to be honest. Margins aren't anything like this, and sort of there's very little in the way of moat. There's a hell of a lot of insurers out there, and I just not really that happy with the model. So yeah, quite like the exchanges. And also quite a nice balance sheet and sort of financials really. So yeah, maybe come back to that on around the next earnings. So yeah, financial economic news. We had a little bit outside of the FOMC. Sort of had UK um, average earnings and sort of employment looking pretty positive. 5.2% average earnings, including bonuses. Yeah, more people getting bonuses. 3-month employment change, 173,000 was expected to be minus 12, so it's a fairly poor estimate. Last period was revised up from 219 to 253, so yeah, pretty solid. Unemployment sticking at 4.3%, so yeah, UK sort of looking up slightly. Inflation was pretty much as expected. Core CPI 3.5%, up from 3.3, admittedly, but everything else largely on track. FOMC, as we know, lowered to 4.5%, but off the back of our inflation news, 3.5% core inflation, we held ours the same. So we are now 0.25% higher than the Fed, which is rather unusual. Yeah, 4.75. They voted 6-3 to keep unchanged. They were sort of expecting 7-2, but doesn't really make all that much difference. US jobless claims all looking very healthy. Sort of people still saying unemployment is going to go haywire, but it's not showing up in the jobless claims. People still saying sort of people that are losing their job are finding it hard to get one. So continuing claims is staying relatively high, but it's not really going up. And yeah, the core PCE and PCE data was all sort of slightly lower than expected. So this was after the FOMC. Don't know if they actually had these figures, but yeah, all sort of looking a little bit better. Maybe you know, rate cuts could start to come onto back onto the table. Don't really know, but that seemed to sort of fire everyone up on Friday, and we sort of had a bit of a rebound. So as far as the rest of the portfolio goes, we had sort of a fair whack on Bitcoin, and this sort of knocked the Bitcoin miners, CleanSpark and Riot, sort of into the 11s. Gold and silver sort of took a whack. Kur Mining and Equinox Gold sort of down at reasonably low points. I did buy a little bit of Fresnillo, Fresnio. So yeah, that's becoming a slightly larger position. Sort of a little bit low on cash. Thinking about putting the rest of it into Fresnio as well. I want that silver exposure, and yeah, sort of they're in the red a little now. And Pan American Silver sort of come down a bit. KGHM has gone into the red, and the Interactive Brokers side. So yeah, thinking of, although I've been adding to them. I added a little bit of them in the options account. Nothing this week, but I'm considering sort of adding a little bit more. And yeah, the options themselves got absolutely hammered this week. Sort of, I think 15,000 pound off each of Hive and Riot platforms. So yeah, that nearly 30k gone off them. Himax was sort of at I think 45,000 at the highs. Really should have taken some profit on that, at least taken my initial investment out, but I didn't. So we'll see where they go. I bought 50 contracts of the Equinox January 2027 call options. So yeah, that's getting a bigger position now, sort of reasonably in the red. But you've seen how much these can swing in a couple of weeks. So yeah, we'll see how things go. 1,500 quid in cash now. I'm looking to probably top that up in some way or another. And yeah, you sort of notice the portfolio is looking a little bit wonky at the moment. Sort of spoiler alert, I sold one Bitcoin at the highs, and yeah, that sort of made everything go a little bit haywire. So I've got 31,000 in cash. I sort of set aside about 50,000 for tax. I don't owe that all quite yet, but just thought it'd be nice to just set some aside for future sales as well. Put that into premium bonds. So overall, the crypto and stocks portfolio is sort of going to be a reasonable amount down, but it was always going to be that way. I was showing pre-tax portfolio basically. So as we start selling, I have to pay the tax, but I do have sort of 30,000, to add into more of these stocks, which was why I was kind of happy that the agriculture side sort of wasn't rocketing up, or even coming down was fairly good. So I can add a fair bit because I wanted to double or triple these sort of smaller positions. So that was quite good. And yeah, portfolio sort of could be a little bit all over the place over certainly the next few months, but we'll see. So leave your thoughts in comments below, and like and subscribe. See you soon.